Welcome to Trading with Candlesticks Part 2, presented by Daily FX Education. In Part 1, you were introduced to candlestick charts and learned why this chart type is often preferred over line and bar charts. Through examples, we illustrated how candles provide more information than line and bar charts, providing traders with the opening price, the closing price, the high price, and the low price on each candle. Additionally, we demonstrated how candles provide speculators with unique visual cues that can help to comprehend market sentiment. And finally, we pointed out that Western technical analysis patterns often take several months to set up, while candlestick patterns emerge in only one to only a few completed candles. With these benefits, traders can more quickly and accurately locate price reversals and identify entries and exits for their trades. After laying this groundwork, we introduced 3 bullish candlestick patterns and 3 bearish candlestick patterns. And in this video, we're going to pick up right where we left off. By the end, you should be familiar with 18 of the most popular candlestick patterns and have plenty of trading opportunities to work with. So let's get started. The first half of this video will focus on single candlestick reversal patterns. Because only one candle is needed for these patterns to emerge, they're often the easiest patterns to recognize. This fact is why many traders like trading off of single candlestick patterns. We're going to first be looking at reversal patterns, so it's important to stress that any reversal pattern found does not necessarily suggest a complete reversal in trend, but often just a change or pause in direction. That could mean anything from a slowdown in trend, sideways trading after an established trend, or a full turnaround following a reversal candle pattern. Now let's get started with the doji. By definition, a doji forms when a candle's opening and closing prices are virtually the same. Visually, a doji candle will look like a cross or a plus sign, and this pattern represents market indecision. As such, this candle formation suggests a potential for the pair to change direction, as neither buyers nor sellers have been able to establish control. Now let's look at a textbook example of a doji formation on a dollar-yen chart. Remember, by themselves, candlestick patterns don't provide us with much credible information to work with, but in conjunction with support and resistance line, candlestick patterns can provide us with great insight. So to get things started, let's plot a trend line here, which you can see has been acting as resistance to the dollar-yen pair. Now let's look for a bearish doji formation to help us locate a solid trading opportunity. Continuing to watch this chart, we get what we're looking for. A doji has formed, and the high of the candle briefly touches the resistance line. Again, because the open and the close prices are nearly equal to each other, we have market indecision. Buyers haven't taken control, nor have sellers. And what's key here is that this is happening near an established trend line or resistance line. With this, we can look for a good opportunity to go short and sell the dollar-yen. In this example, an aggressive trader could open a trade on the open of the next candle and place a stop about 25 pips above the resistance line. A more conservative trader, knowing that the upper wick of the doji was a bit long, would look for prices to retrace a portion of the wick before entering. A conservative trader may look for an entry halfway to 2/3 of the distance up the top side of the wick and place the stop 25 pips on the other side of the resistance line. In this case, the conservative trader is able to tighten the stop of the trade, but also risk missing the trade if prices never retrace up the wick, as you can see it did not in this example. Now before moving on, we'd like to mention that there are 2 rare doji formations called a dragonfly doji and a gravestone doji. A dragonfly doji forms when the opening and closing price equal the high of the day. A gravestone doji forms when the opening and closing price equals the low of the day. Again, these patterns do not form all that often. However, when located, they often suggest that the direction of the trend may be nearing a major turning point. Here are a few quick examples to illustrate this. Notice in each example how quickly the trend changes direction after the candles have formed. The next candle formation we're going to talk about is the shooting star. This bearish candlestick formation appears when the price of the currency pair has traded well above the opening price, but then closes below the opening price. Buyers have thus succeeded in pushing the price quite a bit higher during the session, but were not able to sustain that level. Therefore, it's probable that price action may decline in the near future. To be considered a shooting star, the formation must be in an upward or bullish trend. Also, the distance between the high price and the opening price must be more than twice as large as the shooting star's body. Like all candle formations, this formation becomes most effective when it appears near a resistance area or a resistance line. Here's a situation where prices began to sell off on the pound dollar near the 1.70 mark. Prices then found a short-term bottom around 161 on September the 1st. From this point, we can draw a Fibonacci retracement to determine where potential resistance might be on an upward retracement. Many traders like to look for an entry near the 61.8% retracement level, so let's wait and see if prices will bounce there or not. As the price approaches, we'll be on the lookout for a bearish candle formation to confirm a potential reversal. On September 11th, the 61.8% Fibonacci retracement line is pierced, and a shooting star forms. An aggressive trader would enter on the open of the next candle and place a stop 25 pips above the high of the shooting star. A more conservative trader is going to notice the long wick to the upside and anticipate a retracement of the wick. Therefore, a conservative trader may place an entry 1/2 to 2/3 up the distance of the upper wick and place their stop approximately 25 pips above the high of the shooting star. The next two formations we're going to discuss are the hanging man and the hammer. These candle formations can look identical to one another. What separates them is where they form. The hanging man is a bearish candlestick formation that forms at the top of an uptrend. Generally, it forms after a strong sell-off at the open, but buyers then come back to push the price back up so that the close occurs near the open. The strong sell-off, however, is taken as an indication that bullish momentum can be fading and that sellers may be taking over. The color of the candle can be either red or blue. The hammer is a bullish candlestick formation that forms at the bottom of a downtrend. A hammer will occur after a currency pair has been trading lower and declining for a period of time. Through the course of the candle, the price will trade lower than the opening price, but will strengthen to close higher than the open. Like the hanging man, the hammer can either be red or blue. Let's go back to our previous example where we saw a shooting star on the pound dollar chart. Remember, we were looking for a bounce off of the 61.8% retracement. Once the 61.8% line was pierced, a shooting star formed. After the shooting star forms, you can go short, but let's assume you're a bit more conservative and prefer to have more than a single candle formation to confirm any particular trade. So instead of jumping straight in, you wait. And look, it pays off. Notice how the next candle that formed was a hanging man. The hanging man pattern closed slightly higher than the shooting star, so the conservative trader would now see two bearish candle formations in a row and perhaps open a trade on the open of the next candle. Now at this point I would feel pretty good about this trading opportunity, but let's assume that you still hadn't entered. The next candle, it's another hanging man. So we now have three consecutive bearish candle formations occurring near a resistance line. If you were already in this trade, you'd want to stay in it. This paints a bearish picture, and if you are not in this trade already, I suggest entering on the open of the next candle to go short. You could place a stop just above the high of the shooting star in case there is a retest of its wick. The important point to stress here is that the more consecutive candle formations you locate, typically the better the trading opportunity, especially when these formations appear near support and resistance levels. In this example, things played out fairly well. Eventually, prices dropped over 800 pips over the next several weeks. The next pattern is easy to spot and looks similar to the doji. However, there is typically a long wick above and below the body of the candle. In fact, this is where the pattern gets its name. Due to the long wicks and the thin body, typically right in the middle of the candle, this formation looks like a wooden top that children often play with. A pattern of this nature indicates indecision on the part of buyers and sellers. The opening and closing prices are quite similar, even though prices have demonstrated quite a bit of movement during the course of the candle's time frame. Should this candle appear in an uptrend, it could indicate that buyers are potentially running out of steam, and a bearish move to the downside could ensue. During a downtrend, the spinning top may be signaling that sellers are diminishing, and a bullish move to the upside could be in the offering. There are times when the spinning top and doji will get confused with one another, but what's important is not the correct name of the pattern, but what the picture is telling you. The indecision by traders means that there is possible change in the direction in the near future. If this candle pattern forms near a trend line, then you have confirmation of traders' respect for that given trend line and can look for reversals in those areas. A trader looking at the dollar CAD in late August and early September would have noticed a resistance area forming in the 1.11 zone. Previously, back in the middle of August, this 1.11 area was a congestion zone. At that time, a bearish engulfing candle appears with a long wick to the upside. The bearish engulfing pattern was discussed in the first introductory video. This indicates to me and to traders that there is respect for the congestion zone and its forming resistance. About 15 days later, a spinning top appears with another long wick to the upside. This is further bearish confirmation of the respect traders were giving to the 1.11 price at that time. At this point, we can enter into a trade. An aggressive trader would enter the trade on the open of the next candle while placing a stop just above the high of the spinning top. A more conservative trader would look for a 1/2 to 2/3 retracement of the top side of the wick, placing the stop 25 pips or so above the high. Now I'd like to stop here for a moment to remind you that we feel strongly that traders should always look to profit at least twice as much as they're willing to risk on any trade. This will increase your chances of long-term success. To learn more about why this is so important, make sure to watch the money management videos available in this course series. The previous candlestick patterns that we discussed in this video are single candle patterns. Though they're easier to spot, and many traders like them for that reason, sometimes more data can provide additional confirmation and strength to any given signal. In this section, we're going to look at reversal patterns formed through multiple candles. In the introductory video on candlestick formations, we introduced 6 multiple candlestick reversal patterns: the bullish engulfing, the bearish engulfing, the morning star, the evening star, the piercing line, and the dark cloud. There are 3 additional bearish reversal patterns that I'll discuss in this video, and then I'll conclude by covering a few continuation patterns. Now the first bearish reversal that we're going to go on with in this video is the abandoned baby. The abandoned baby is a rare bearish reversal pattern characterized by a large move up followed by a doji or small candle, and then a third candle heading in the opposite direction. The formation reflects a classic 3-period reversal of market sentiment, where after a bullish trend, enough sellers enter the market to take control. They first stop the trend's momentum up with the doji, and then ultimately reverse the direction of the trend. As you can tell from the picture, this pattern takes on qualities similar to the evening star. Also, if you just knew of the doji formation, you could trade this pattern based on the doji alone. Now, here's a daily chart of the dollar-yen. You can see that a strong downtrend has established, and an abandoned baby has formed at the trend line. Let's take a closer look to see how we can place a trade here. Like other candle formations, we'll want to wait for the pattern to fully form, with the last candle in the formation closing. Then we can place a trade at the open of the next candle like you see here. Because prices could retrace, we'd want to place a stop just above the high of the formation above the trend line. In this case, price action does continue down, allowing us to capture at least 2 times the amount that we were willing to risk on this trade. Moving on to the 3 inside down pattern. This 3-candle pattern begins with an uptrend. The first candle in the formation is a large blue candlestick. Then on the second candle, the price is driven down, as shown by a red candlestick, reversing some of the upward movement from the previous day. What's most important about this formation is that the entire second candle, including the body and wicks, are contained within or inside of the first candle. This strongly suggests that buying pressure is weakening. Then the reversal is confirmed as the third day forms a red candle, which completes the bearish pattern. Let's now take a look at a trading example. This is a daily chart of the dollar-yen. You can see here that a 3 inside down pattern has formed, but something doesn't look right here. This candle formation is bearish, but price action right now looks fairly bullish based on this trend line. In an upward trending market, we should really only be looking for buying opportunities. So should we act on the bearish 3 inside down pattern? Now, I've pulled up this example for a specific reason. I'm using this example to emphasize another important concept of trading. The concept is perspective. Many times traders do not look at the market from more than one perspective. Here we're looking at a daily chart of the dollar-yen. Assuming this chart provides us with enough information to trade on, we might wait for price action to fall to the green support line and buy in the direction of the trend. But it's always good to get more than one perspective on what's going on in the market. So let's take a step back. This is still a daily chart of the dollar-yen, but looking further back into its price history. Right here is where we notice the 3 inside down candle formation at the end of the apparent strong uptrend. When we look at the dollar-yen price history from this perspective, it certainly looks like the pair was trending down quite strongly, not up. And I've drawn a Fibonacci on the chart from the high around May of 2007 to the low around March of 2008. The reason being, the former uptrend that we saw in the previous look at this chart now really looks like a temporary pullback up to the 50% Fibonacci line. Therefore, by looking at a longer time frame, we've done a few things. First, we've recognized that the larger trend is down, not up. Second, we found price action testing a 50% Fibonacci retracement, which typically provides strong resistance. And third, we've now found a bearish 3 inside down candle formation right at the 50% fib line. Now, I really like this trade setup after taking a bigger look at the picture. I've now built 3 solid reasons to go short on this trade. So I can go short at the open of the candle following our bearish formation, and I'll set a stop just above the high that pierced through the 50% fib line. I could have stayed in this trade for at least a month while collecting a significant amount of pips as well. I hope this example has helped stress how important it is to take a look at the market from multiple angles and perspectives. Just because a trade looks good from one perspective, take another look. Maybe you're missing something. The more confirmation you have, the more likely the trade will turn out to be a good one. Let's now move on to our last multiple candle reversal pattern, the tri-star. This is an extremely rare pattern characterized by 3 consecutive dojis forming at the end of an uptrend or a downtrend. Remember, dojis represent market indecision. Because a doji opens and closes at or near the same price, this means that neither buyers nor sellers have been able to move the market. When 3 consecutive dojis form, serious indecision is present and typically major reversals will follow. This pattern is not very common. However, you can see this kind of price action more frequently during periods of limited market activity like holidays. If this pattern is found at the bottom of a downtrend, look for the market to reverse to the upside. If this pattern is found at the top of an uptrend, look for the market to reverse to the downside. We recommend entering a trade on the open of the first candle that follows the tri-star pattern. You can place your stop just on the other side of the most recent high or low. Make sure that you're taking profit at least twice the distance of your stop. Here's an example where we could be looking to go short at the open of this candle, placing our stop just above this high. Now let's move on and take a look at continuation patterns. Continuation patterns suggest the market will maintain an established trend. Continuation patterns help traders differentiate between price action that is in full reversal and those merely taking a pause or slowing down. Let's first look at bearish continuation patterns, starting off with the following 3 methods. In a downtrend, a long red candle first occurs. The second, third, and fourth candles are short candles that fall within the range of the first. The fifth candle then continues the downtrend with a long red candle that creates new lows. The following 3 methods pattern occurs in a bear market, where during a downtrend the market rests before resuming the trend. The bearish trend's break is reflected by small candles that all stick to a strict market range formed by the aggressive move on the first candle. A typical explanation for this type of formation might be that the market is slowly digesting the relatively large move in candle number 1. These small ranges often precede a significant economic report. Such periods of relative inactivity and tight trading are common in markets. falling three methods is confirmed where a red candle drives down to new lows, reinstituting the bearish trend. Notice here how we have an established downtrend at the end of a falling three method formation. You can see how candles 2, 3, and 4 of the pattern all stay contained within the height of the first candle. And then candle 5 is a strong down move, making a new low. To trade this pattern, we recommend waiting for the pattern to complete, and then enter the trade on the open of the next candle. You'd place a stop just above the lows of the first candle. Many times after the breakout occurs, prices will come back to test what was former support, which is now resistance. That area would be the low of candle number 1, which could be used to enter an additional trade as well. The second continuation pattern I'll discuss is the bearish three-line strike. After an established downtrend, 3 long days in a row continue this move, each closing lower than the previous day. Day 4 is a blue candle that closes near the open of the first day. The first 3 days serve as a fairly clear bearish move. Up to day 3, in fact, we have a 3 black crows formation, which is a strong bearish signal. On the 4th candle, we have a 1-day rally that only goes up to the open price of the pattern start. This could be more sellers covering their positions than any true sign of a reversal. Thus, traders will watch for short entry opportunities to come. This pattern is often mistaken for a bullish engulfing. The move is predicated on short sellers covering their positions. Therefore, traders are taking profits in anticipation of support or possibly an up move. I would be careful about trading this pattern since the price would be extended and trend is possibly losing steam. If you see this pattern evolve, look for resistance areas to sell into, preferably with a bearish candle formation. Now let's briefly look at 2 formations which are opposite of the 2 patterns we just discussed. The rising 3 methods is a bullish continuation pattern that is the opposite of the falling 3 methods. This pattern occurs in a bull market where during an uptrend, the market rests before resuming the trend. The bullish trend's break is reflected by small candles that all stick to a strict market range formed by the aggressive move on day 1. The 5th candle is a long up candle which closes at a new high. Typical explanation for this type of formation might be that the market is slowly digesting the relatively large move reflected by day 1. The small daily ranges in the middle candles often precede significant economic reports. Such periods of relative inactivity and tight trading are common. Rising 3 methods is confirmed where a blue candle drives up to new highs, reinstituting the bullish trend. A trader would initiate a position when the 4th candle closes above the high of the first candle. The number of candles in this formation can vary. The key is to identify a solid blue up candle. Then a series of candles will form inside the high and low of the first candle. Here's an example from the Australian dollar Canadian dollar in March of 2009. The first candle created a solid up move. Then 5 candles consolidated inside the first. The 7th candle broke out to the upside and closed above the high of the first candle. A trader would initiate a long position on the closing of the 7th candle. You want to place a stop below the high of the first candle. Next, we have the bullish 3-line strike, which is opposite of the bearish 3-line strike. This begins with 3 blue days occurring in a row, continuing an established bull trend. Each day should close higher than the previous day. Day 4 is then a red candle that closes near the open of the first day. So long as the previous uptrend is an established one, candlestick analysts view the 3-line strike formation as a sign that the uptrend may still continue. The first 3 days serve as a fairly clear bullish move. Up to day 3, in fact, we have a 3 white soldiers formation and a strong bullish signal. 1 day of sell-offs that only goes down to the open price of the pattern start is considered to be more of a sign that longs are covering their positions than any true sign of a reversal. Thus, traders will watch for a long entry opportunity to come near support levels. The foregoing is a wide-ranging sample of individual candlesticks along with various candlestick patterns. Both the single candle and the multiple candle patterns can provide valuable insights for the trader who cares to put in the time and the effort to learn how to interpret the information that candles are providing. Something we'd ask you to keep in mind is that the reading and the interpretation of candlestick charts are both quite subjective, more of an art than a science. Knowing that, looking for a 100% Precise duplication of the candles and patterns you have seen may cause you to miss solid trading opportunities. Modest variations can and will occur. Like anything else, the more you study the charts, study the candles, and learn to understand the data that they are giving, the more you will see the value in your trading. We hope you found this video helpful, and we do encourage you to attend a live webinar on candlesticks with our course instructors. In the webinar, instructors will relate what you have learned here to current market and trading conditions, and include some patterns that have recently formed or are in the process of forming. Instructors will also field Q&A on the topics of candlesticks. Thanks for watching this video, and we look forward to seeing you in the future webinars.